Hello, everybody. This is Ted Bauman here, editor of Bauman Daily and the Bauman Letter. We're doing your money matters today, but we're doing it a little differently. Angela Giroux is not going to be joining us today. Instead, Clint and I are going to be really having kind of a friendly chat about what's going on in the markets, and in particular, what is likely to happen as a result of basically the Fed's increasingly hawkish approach to interest rate management, and more particularly the management of its balance sheet. And just to give you a little bit of background on what that means is, I mean, basically over the last decade or so, the Fed has been buying financial assets out of the market, treasury bills, mortgage-backed securities, and those go onto the Fed's balance sheet, and it buys them in return for reserves that banks can use if they so choose to do things like lend money or just stick them in their reserve accounts at the Fed. But whatever it is, it's supposed to ease financial conditions. Since COVID, that has taken on, it's got to the point where the Fed realizes that this is not helpful anymore, right? I mean, basically, that's what the deal is. A lot of people blame the Fed for inflation, but really, all this, Clint, isn't it? It's about asset price inflation. So what we're seeing now is a collapse of those particular assets that depended so much on the Fed's, this quantitative easing and all this kind of stuff. So Clint, walk us through what's been happening.
Yeah, well, I think I think what's caught a lot of people by surprise, a lot of investors by surprise, is how quickly the Fed's views have evolved, because we're really only talking about a little bit over a month here from the time when they started dropping the whole, it's transitory messaging from the inflation picture to acknowledging that risk, to then pulling forward expectations for rate hikes, pulling forward the expectation to start to taper the asset purchases that you were talking about under quantitative easing. And then we got another surprise with the Fed's minutes from the most recent meeting this past week, when they came out and said after they implement that first rate hike that they could start to actually reduce the balance sheet. So with tapering, all that is just slowing purchases. I mean, the balance sheet can actually still grow under tapering. They're still purchasing securities. It's just at a slower amount. Now we're facing this the scenario to where you could actually start to shrink the balance sheet and kind of accelerate that effort to take more liquidity out of the system.
So let's just show a picture. Here's a chart that comes from Goldman Sachs. It shows basically what their expectations are, and they're saying they expect rate hikes in March, June, and September. Normally, they'd be 250 basis points each, and then they say they expect balance sheet runoff to start in quarter 4, but maybe it'll happen in quarter 3. But basically, what all of it means is that the Fed is going to be pulling out of this part of the market. But I want to kind of challenge, the conventional wisdom on this. People say that the Fed needs to do this to stop runaway inflation. But what does the Fed have to do inflation, Clint? I mean, tell me how does what the Fed's doing contribute to inflation? See if you can figure that one out for me.
I mean, we've talked already about how it contributes to asset price inflation. Yeah. I mean, a lot of what we're seeing today has to do more with the disruptions that we're seeing in supply chains. What I think is interesting is right when they've decided to drop the whole transitory messaging from this, we've actually seen a couple signs that pricing pressures are peaking out. So, one of the things I watch is with these PMI, the purchasing manager indexes and manufacturing service sectors, they have, you can go in and look at all these underlying components of it. And the prices paid component for the manufacturing one dropped pretty significantly in the last report. Now we'll see if that stays the trend, but I mean, you've talked recently about policy mistakes. We'll see if we have one in the making.
Yeah. So basically, look, I mean, what a lot of people say is that the Fed is trying to address inflation that wasn't caused by the Fed and that can't be ended by the Fed. So we know about cars, we know about used cars, we know about energy, we know about all these things that relate to supply side issues. But at the same time, the Fed has got a public relations issue too. I mean, if the Fed is not being seen to be bullish about inflation, that sends panic through the markets, whether that panic is justified or not. So what we got now is a situation where the Fed says it's going to do all these things. So let me just show a couple of charts. We'll try to keep the charts to a minimum. I just want to show what's going on and how rapidly all this is changing. Here's a chart that shows the 10, 5, and 30-year yields on Treasury bonds. And it goes back to mid-December. Pretty clear what's going on there. They started to tick up mid-December, but look what's happened since the beginning of the year. That's a pretty steep increase, and that's all due to the Fed, right? So the next chart just basically says, look, here's what's happening to the overall indexes. There's the Dow, there's the S&P 500, but look at QQQ and IWM. Those are proxies for tech and for the NASDAQ, pretty steep dives. The last chart I'm going to show you is the so-called FANGs, or at least some of them. This is since the beginning of the year, so not a lot of data here, but the message is clear. These big stocks it's not just the small tech growth stocks, right? It's also the big ones. So why would that be happening?
Yeah, I mean, that's what I was going to say. Let's tie this all back in, whether, the Fed causes inflation or not. What we do know is that their tightening policy, their hiking rates, we talked about how it's draining liquidity from the system, but, what does this mean for stocks? Well, especially in the growth space, there's two big factors at play here, as you see interest rates rise, as we were highlighting. One is just the competition for capital. I mean, money is going to flow to where it can earn the best return, and rates have been stuck at zero. And we've been in a low rate environment for so long. So as yields on, safer fixed income investments start to come up, that's going to be more competitive for investor dollars. Now, the other thing, and this is where this really hits the growth stocks, is rising rates makes future cash flows worth less. And that's a big sticking point for growth stocks. You're paying a higher valuation now because you're expecting all these profits down the road. Well, all those profits down the road when you discount those back at a higher interest rate, they're worth less in today's dollars. And so that's the big impact you're seeing now. I think the big question too is this kind of across the market? Are we now sort of the .com peak, and it's a waterfall decline sort of from here, or is this just more targeted to those specific growth sectors, tech sectors?
Well, let me comment on that, because I was going to say earlier when you talked about the Fed making a policy mistake. I think the Fed is actually playing a double game here. I think what they're doing is that they are publicly saying that they're addressing inflation in consumer markets, but they know full well that they can't do that. That's not what's driving inflation. If inflation is being caused by supply side stuff, and also by the enormous amount of money that the Fed or that the federal government has pumped in to the economy in the form of stimulus. I mean, let's just be realistic. Everybody, whether you're a Friedmanite or whether you're into MMT, whatever it is, everybody agrees that a lot of money is chasing few goods is going to cause inflation. Fine. All right. Now that's all disappearing, and the Fed knows that. I think what the Fed is doing is signaling that it wants to start reining in the froth in asset markets. I think that's what this is really about. But they're not going to say that because they don't want to spook the markets. But people have been talking for years now about how the Fed has dug themselves into a hole and they need to climb out of that hole and fill it in. You can't carry on where the Fed is essentially propping up asset markets, where the Fed has got a huge put under all these assets. And so now they got to fall. So the big question is, which ones are going to fall? And you spoke about smaller cap growth stocks, the ones that are very interest rate sensitive. But what about the big ones? What about the ones that have carried the market for the last year? I'm going to ask you to comment on that, but I just want to flash up. This is a table that shows the current price to earnings ratios and various other metrics for the big guys. The Teslas, Amazons, and Apples, and all that. Their forward PEs, in some cases, Apple, Alphabet, Facebook, not too bad. Microsoft, not too bad. But, the further up you get, Amazon 64, NVIDIA 53. And I mean, those are very, very high. And then price to sales. I mean, Tesla price to sales, NVIDIA, Microsoft. I mean, those are pretty high. I mean, that's a lot higher than the 10% or the 10 that we normally recommend. And then, of course, PEG, if anything over 1 is considered to be a little bit overvalued. So my key thing here is simply that, what if it's not just the small ones? What if it's the big ones too? Then what happens?
Yeah, so I think there's a couple really important implications for how investors approach 2022 here. And you can, I'll give you an example of what we've seen just to start the new year with this week. So here's a table that just shows this is through Thursday, the year-to-date returns for sectors in the S&P 500. So you've got the sector returns, then you got the sector weight as well. So now overall, once again, this is as of Thursday, the market's down about 1.4%. So the S&P is down 1.4%, but you can see it's not, we're not seeing red across the board. I mean, you have sectors like energy, financials that are putting up some pretty nice, decent sized gains on the year. But when you look at their weight, I mean, their combined weight is about half of what the technology sector is. So, a lot of those names you were rattling off are in the tech sector. Tech sector is the second worst performing sector here on the year so far. And so we're in this scenario, we're in this situation where, it looks like the broader market is under pressure, but it's really, this concentration that we've seen at the top in terms of market cap. Those are, the ones that are more susceptible to these valuation pressures. And so they can bring the whole, so this is important, especially if you're an index investor. If you're holding the SPY ETF or you're holding the QQQs, 2021 was very good to you. 2022, with these valuation issues, if we start seeing that pressure at the top, that could be a very different story. Meanwhile, average stock, especially with what we've seen in cyclicals and on the value side, have started off the year very well.
Yeah. So, I mean, a lot of it comes down to what some people are calling a rotation. And, we were discussing earlier a Bloomberg article that came out this morning saying, this is a rotation from what was the big thing really for the last decade into cyclical and, real economy stocks. And this is something we've been talking about a lot, really going on for the last 6 to 9 months or something, saying this is going to happen. At the Bauman Letter, all of our major selections over the last 6 to 9 months have been all about, quality, about, earning cash flow, about paying dividends. And people say, oh, well, but you didn't beat the market. Well, that's because we're preparing ourselves for what's coming. The market last year was overweighted towards those stocks that on your chart, if we can flash that back up again, I mean, look, those charts, that information technology is down there, 29% of market cap, but it's down 3.25% already. If that carries on like that, then you're not going to get gains at the index level, and you're not going to get gains, for those kind of stocks. So where are you going to get them? You got to go looking elsewhere. So we've been kind of preloading ourselves for this, and people will say, well, yeah, but you recommended a REIT or whatever, and it's down by 5%. Who cares? I mean, it's paying a dividend of 6%, right? And it's it's going to raise that dividend, and it's like, for example, if you're buying REITs that are undervalued because of people are worried about the pandemic and COVID, well, they're bouncing back already, right? Because we know that Omicron is not as serious as the previous strains. I think that's the way to go. I think you got to go looking for quality, for cash flow and earnings. And I know there's some people are going to go, oh yeah, but you're being an old fuddy-duddy. Well, we'll see. It's all.
Yeah. I've got one comment and then one question for you. I mean, sure. The comment is, yeah, so we're seeing the sector rotation. That's what it looks like, at least so far this year. Even though the indexes are down, what we just highlighted, it's a lot of the mega cap tech names dragging the market slower. One thing I would absolutely be fixated on fixed income markets this year to try to determine if the sector rotation becomes part of a bigger meltdown. There's two key signals I would watch for. One is high yield spreads. High yield spreads started moving higher well before the dot-com bust. They started moving higher in late 2007 before the financial crisis. High yield spreads have stayed low so far. That's one area I would keep an eye on.
We're talking about corporate borrowings,
right? Exactly.
Junk borrowings and stuff like that, which is a very, very sensitive thing, because you get financial crises. That's how they start, when those spreads get very high.
Right. Then the other fixed income signal is just the yield curve itself. For example, you look at the yield on the 10-year Treasury versus a 3-month Treasury. The yield curve, once again, going into .com, became inverted. Either it's a combination of the Fed raising the short end or long end rates coming down because of a lot of times because of the growth outlook. But yield curve went inverted before .com bust. It went inverted before the financial crisis. Today, right now, the yield curve's actually been steepening. That could change. What's that?
Right. And I think that's precisely because I think the current view of the market is that the Fed is going to raise the short end, but the long end is going to also raise, which is what we're seeing with the 30 is up. And that's because they expect the economy to be strong. And so therefore, they think that we're going to move from a situation where everybody was plowing their money into speculative assets because there was nothing else to do because of COVID, into an economy that's recovering where everybody's going to start spending a lot of money. And that will then lead the Fed to raise interest rates in order to kind of cool things down, which is actually a good sign. Right. So if you get short-term and long-term interest rates rising, and paradoxically, that's probably the best thing, because it shakes out all these nonsense stocks that are overvalued. And yeah, we bought some of those too when they were overvalued, because who knew? You know what I'm saying? I mean, it's, these things are completely unpredictable.
So what do you do with those?
Where do you go next?
So what do you do with those now? Because once again, the yield curve, high yield spreads, or whatever. I mean, it all suggests that we're not seeing a broader stock market issue, but we are seeing an issue with those growth stocks. I mean, what's the process that you would go through to look at these if they're in your portfolio and you're trying to decide if one's worth holding on to versus cutting? What are you looking at in that regard?
Well, really, it's pretty straightforward. And the main thing is I'm looking at revenue estimates for the next 2 years and where that revenue is likely to go. So you take the base case that if the price to earnings ratio stays where it is right now and revenue increases and you get potential earnings per share increases, just mathematically what's going to happen to the stock price. If it's enough to justify holding, you hold. If it's not, you don't. The other thing, of course, is analyst estimates, because it's not just about revenue, is it? It's also about just the what's happening with that company's positioning in the market. So there are a lot of companies that don't look like they're going to have huge revenue growth, but analysts love them because a lot of things can happen between now and then. So I'm looking at those two things in particular, but the main thing is I want to know, what is the current price of the company relative to its earnings, say, in 2023? If it's ridiculously high, that means that it's going to take way too long for that stock to get back, to where it's a reasonable investment. So let's just rather sell it, take the money and rotate it into something else. That's the way that the ball bounces. But I think the key thing is you have to look at earnings and revenues, and that's not what was happening 1 year ago, was it? That wasn't the way people were investing.
Right.
What was GameStop earning a year ago? I don't know, probably nothing. But look what happened to its stock. So is that all over, Clint, or do you think there could be a double bounce in those kind of stocks?
Oh, I mean, you know what? I mean, look at what have they done since then, I guess. I mean, go look at a lot of the meme stocks and what they've done off of that initial surge. I mean, that I remember for a long time, everyone's screening criteria was just basically based on short interest. It's like what stock has a high short interest? Let's plow into those and see if we can generate a short squeeze.
I don't see that happening right now. I don't think the retail guys are going to disappear, but they're not going to drive the market. Or if they try, I think they're going to learn old lessons, old fuddy-duddy lessons pretty quickly. Anyway, that's all we got for today, folks. Remember, the Bauman Letter and Bauman Daily are yours to subscribe to. You can click on the link above here, or you can click down below if you'd like to subscribe. We'd love to have you on board. It's risk-free. Basically, anytime within the first year, you're welcome to get your money back. Anyway, Clint, thanks for talking to me. We'll reconvene next week.
See ya.
Cheers.